Welcome, everyone. It's Angelo Robles to the Angelo Robles podcast. I'm also the founder and CEO at Family Office Association. Today's subject is Nigam Arora, the most accurate stock analyst in the stock market. He might be, because I really love his stuff, and it's an honor to have him on. And again, that's Nigam Arora of the Aurora Report. Nigam, welcome to the show.
Thank you, Angelo, for having me.
Oh, it's a pleasure. I know my audience wants me to get right to it. They always claim that I do too much nonsense to begin. So why don't I just jump right into it? Looking at things from a global perspective as an investor, there's probably many things that you look at, but we probably don't have the time to necessarily go over all, whatever it is, 29, 36, 102. If you had to identify for traditionally ultra high net worth investors, what are three economic indicators you would recommend that they become familiar with?
Sure, Angelo. Right now, it's I'll go a little past economic indicators, the Fed policy, and we have to read tea leaves as to what the Fed is really going to do. Here, Fed and of course ECB. In last ECB meeting, there was a tiny surprise. They announced they will accelerate their bond purchase to slow down the rising yields, which at least I did not expect that. This market is driven by the debt binge, the money printing, the low interest rates. And you may remember past tantrums when the Fed tried to raise rates. Fed is pretty committed. They're not going to raise rates. They're going to keep easy monetary policy. But I think Fed is getting into an untenable position. I don't know if they're going to be able to maintain that position as long as they say they're going to. Mm-hmm. And that is the single most important thing to watch these days. All other indicators, and I watch all of them. We watch indicators from 23 different countries. But everything is secondary. We have to watch Fed, and that's it.
Very interesting. So, I always believe, there's dozens to hundreds of indicators we could look at, and some people use AI and algorithms. And depending on the situation, the timing, I guess any of that could work. But even an ultra high net worth investor, they may get information overload. And I've had multiple guests, Adam Robinson and others, say, stop it, simplify it, try to narrow it down mainly to two or three. So I think that's great advice. Things I guess that I would look at include the 10-year yield, pretty obvious there, a little bit tied into what you're talking about. And if you want to get a little more creative, I guess you could argue the price of copper divided by gold. And there are certain other things that people would look at as being intriguing, but there's nothing that's foolproof. If it was that easy as picking your three best economic indicators, we'd all be the world's greatest investors. It's not easy, is it?
No, but let me tell you what we do. We have a model which we call ZYX Global Asset Allocation Model. And we have indicators in 10 different categories. And they go from monetary policy to leading economic indicators to internals of the stock market to commodities to currencies and so on, sentiment and so on. So that is an algorithm that we use, and it's an adaptive algorithm. Adaptive meaning it changes with market conditions. Static algorithms, maybe they work sometimes and they don't work, but this is a feedback loop. So it's feeding back itself as to how accurate it's being, and it's always adjusting in real time. So that is our mainstay for what you're asking for. So what happens is, as a result of that algorithm, although we're using lots of indicators, a lot of things from a lot of different places in the world, coming from a lot of different directions, we don't have to look at them every day and try to figure it out. We're looking at the output of the algorithm and saying, okay, what does it say? Tell us now. So that's how we do it practically.
And I want to ask a very broad, open-ended question, but I'm intrigued by your response to it. How should stocks be valued in this unique environment, COVID and other things that we're going through?
Well, it's fairly straightforward in my book, and it has always been fairly straightforward. if you want to, so there are two aspects. One is you want to make money, your rewards. Second is your risks. Okay. And in all my analysis, after stumbling through this for 20 plus years, finally I concluded that on the money making side, valuations don't matter. You just ignore it. But then there's a risk control side where valuations do matter because you can get so far ahead of valuations. So right now, again, on the money making side, valuations don't matter. Risk control side, we have to pay attention to valuation. Now, your question is how should they be valued? Well, you have to value them in relation to two things. One is your 10-year yield, or what we anticipate it to be. And the second is what's the future growth of earnings we're looking at, right? Those are the two mainstays.
Yeah, that makes sense. And I would pretty much, from my perspective, agree with that. I'm going to ask what could be a tough question, depends on your perspective. Did the Fed use COVID in March of 2020 last year as a cover to rescue the repo market?
I think they did. I really think
that makes at least two of us. Okay, that simply, that one word answer is actually a very accurate one, given that I probably have 100 questions, but I did want to get your opinion about that. Let's go a little bit back to stocks. So we're all steeped in, there's value stocks, there's growth stocks. And yeah, there's a million variations of micro and small and mid and large cap. We'll ignore that for the second. You're probably going to disagree, but I've scratched my head a little bit on this one relative to all I hear about now is, value. It's going to make its comeback. And that's where, the mathematics of the PE ratios and all that work out. But if you look at what happened in the last year and you look at some dominant global companies in tech, the FANG, Microsoft, Tesla, what do you think? Do you distinguish heavily between value and growth, or aren't all stocks effectively, I'm buying now for it to go up in the future? Shouldn't they all be growth?
Well, I kind of halfway agree with you. Little bit, maybe not a difference, but maybe it's a matter of semantics. So we talk about, I think we need to start with a time frame. What time frame are we looking at, right? So what we do in our investing, we divide it into different time frames. So if I'm looking at a very long term, even right now, I think it really doesn't matter if it's a value or if it's a growth, because all you want is you want your stock to go up in the next 10 years and go up a lot, right? It really doesn't matter where it came from. Now, traditional definition would be those stocks will do that and value will not do that. Now, if you start looking at a smaller time frame, let's say next 3 months, 6 months, sometimes even a year, market is kind of like a weather, right? It's like a fashion, right? Right now, the fashion is let's buy value stocks. Those stocks are overextended. And, when we try to take a present value of those stocks, discounted cash flows, especially the real high flyer ones. I'm not talking about Microsoft. I'm talking about where there aren't a lot of earnings like snowflakes and so on. So we can, have a model and say, hey, their present value is lower now than that was, a few months before. So we can take that kind of rationale. So in managing the portfolio, especially for a ultra high net worth individual or a family, I think it's most important to be strategic first. If you get the strategy right, you can do very well. Now, if you get the tactics right along the way, you'll do even better. But if you get tactics wrong, you'll still do fine. So from a strategic point of view, I think what you have to do is, so what I have narrowed down to is, instead of growth or value, what I call is a change. Where is a change happening? Is that change likely to succeed? And is that change durable? And that's where you want to be for most of the time. Now, technically, you can say, well, everybody's going to buy value stocks over the next 2 months or 3 months or a year. So let's have a part of the portfolio, get ahead of that. So think of your portfolio in different buckets. So you can have some tactical buckets and some strategical buckets. And that's how you kind of stay diversified and do well.
I mean, in terms of some of the things that we're classically taught to look at, I mean, obviously PE ratios, price to sales, price to book. I mean, those are probably three of the most common.
Right.
Do you think those are still relevant? Apparently,
No. It's so funny. I wrote an article back in Forbes, I think about 8-9 years ago. And my editor called me back and said, Nigam, what are you talking about? That's how we study. That's how we know. What do you mean these ratios don't matter? And my response was, well, when I look back, ratios did matter at one time and so on. Now, if you can make money by ratios, right? Every Tom, Dick, and Harry can get all the ratios you want, right? Price earnings, the price sales, and so on. If that made you money, you will have a lot of billionaires, but we don't.
Yeah, for sure. I want to go back to something that I hinted at earlier, and that's the tremendous ride last year that a very concentrated group of well-known public stocks had. We define them as the FANG, adding
Sure.
Microsoft and Tesla. I don't know if you want to go one by one to those 7 or whatever it is, but maybe picking out 1 or 2. I mean, these are globally dominant companies. Unless they get hit with some kind of antitrust and broken up here in the US, it's hard for me to imagine that they're just not going to do well. But when I have people like yourself on, they all appear to be very, very skeptical about the shorter term. And we could get into the impact of tech being deflationary and all that. We may jump into that later, but why don't I get your opinion of some of the FANG?
Sure.
I'll hold off on Tesla because I want to get specific to that in a couple of more
Sure.
minutes.
So let's also hold off on Netflix, because that's kind of a little different. But the other ones, the Facebook, Amazon, Apple, Google, Microsoft, let's put that in there. Angelo, I think you're right. They're all in our portfolio, very long term, and we are not reducing positions. If there are any dips, we probably will add to those positions. It's just very hard to see. See, the thing is, when you look at something like the stocks that I just talked about, the cash flows are so tremendous. So if future cash flows you are discounting by 1.6% a year or 2% a year or even 2.25% a year, yeah, in a model it makes difference, but in real life the stocks are driven, as you know, by sentiment and all kind of other things. It really is immaterial. Okay. Now, if we saw interest rates are going to go to, if we saw 10 years going to go to 3-4%, I think it'll matter. But going to 2.25, 2.5, it doesn't matter at all on those stocks. Where it matters, where the interest rates matters are, and again, I'm stepping out of your question a tiny bit, so I won't spend too much time on it. When you have a stock like Snowflake, right, or DocuSign, or Teladoc, those kind of stocks that are very, very popular, even the slightest change in interest rates is going to matter.
Now, there are some that would say, I'm going to diversify and have many, many different stock holdings. They could do that through an ETF, or if they really want to manage specifically the portfolio, they could buy dozens or hundreds of individual stocks. I'm going to scratch my head a little bit and say, well, if you're going to do that, you probably should just buy an index for the most part. But you're going to get a lot of losers, as we saw last year in there. So this appears to be, after not so for about 10 years, a bit of a stock picker's market. Do you think that even a very wealthy family, $100 million plus, do you think they could get all the equity exposure they need by investing in a concentrated basket of 15 or 20 stocks?
So I've done a lot of work on this, Angelo, over a period of time. And so, I look at our subscribers. So we have 4 different services, and there are different groups of people, okay? people who are able to manage can do better with individual stocks precisely for the reason you said, because with ETFs, you're going to get a lot of losers. The issue always is people are busy and their advisors, who their advisors are, how much time they're really devoting to. Because as you know, and I know, and we have thousands of advisors who are our subscribers, and they have limited time to deal with individual stocks and paying all the attention that's needed. So it really comes down to, who that person is or who that family is, and who their advisor is, or advisors are, and how much effort is being put in. When you are with individual stocks, you have to put in more effort. There's no doubt about it, compared to ETFs. Because things do go wrong, things do go right, you have to trim. There are all kinds of things that are happening you have to pay attention to. Now, let me tell you a solution for a lot of people that we have done.
Okay.
And which is very, very popular. What we have done is we allocate a certain portion of the portfolio to individual stocks and a certain portion to ETFs. And how much goes where kind of depends on, again, how much bandwidth the investor and their advisors have to deal with it.
Would you recommend for an uber rich, let's say American family that wants to believe that it is a stock picker's market, maybe they do want to be concentrated in 15 or 20 positions, but I look at the FANG and some of the other companies that we mentioned, they're all US centric. I can make the argument that maybe that may be the right approach in the US because there's so much research and information on those companies to make a decision, but maybe internationally, you should be more diversified and you might be better off having broad diversification through country-specific ETFs or other ETFs. What do you think?
Oh, definitely, definitely. So we are basically giving some allocation guidelines between for uber rich families, money managers. We have a lot of money managers as our subscribers, and people who can handle it, okay, who can deal with it. So right now, our ideal mix is we are 10 to 15% in emerging markets, primarily through ETFs. Okay, too hard to decipher individual stocks. You can get some big ones, but it's difficult. Okay, and then 30 to 40% we are in just ETFs, mostly ranging from sector ETF to very specialty ETF, and the rest is in individual stocks and concentrated portfolio. I'm kind of against 15, 20 stock based on just my own analysis and my own experiences of back testing. I think you ought to be around 30, 33 stocks, somewhere in there. But, that's not a big deal.
Of course. Let's circle back to two of the companies that may need a little bit more context. You mentioned one of them, so I'm going to let you lead with that, and that would be Netflix. Obviously, during COVID, the timing was perfect for them. They have a great corporate culture. We're all familiar with it, and they really thrived. But I suppose we're investing, again, although some of us may be traders very short term, looking more long term. What do you think the future, from your perspective, of Netflix?
Right. So, Angelo, one of the things that, our members, I have a lot of principles, a lot of kind of, markers that we follow, a lot of guidelines. And over a period of time, people started calling them laws, Arora's laws, and now we have a series of 30 Arora's laws. And the second law is nobody knows with certainty what's going to happen next. I think you'll buy into that. And then, of course, the next law is the only realistic thing you can do is look at probability, because you don't know what it is. So Netflix, I think there is a probability, significant probability, that Netflix may run into trouble. Simply because if you look at a valuation, and they've done well, no doubt about it, right? If you look at evaluations, look at the competition that's coming. And again, they're far ahead of everybody, but there's a lot of competition coming in streaming now. And if you look at their valuation, their cash flow, I think Netflix could run into trouble. So Netflix is not in our long-term portfolio anymore. As a matter of fact, and you kind of mentioned short-term, long-term. I won't do very long-term. So we maintain several lists. And one of my lists is potential stocks to short sell, which everybody does that. And I'm not advocating everybody short sells. As you know, there's very high risk in short selling. It's highly specialized. But Netflix is out of our list to buy to a potential list to short now. And I hope I didn't hurt anybody's feelings there. I know Netflix is great.
No, we want you to be a little controversial and hurt feelings. Otherwise, it's boring, which leads me to a couple of upcoming subjects that really definitely bifurcate the audience. So I'm asking these to actually get a little bit of that back and forth. The next company is going to be Tesla. My audience knows I think Elon Musk is the world's greatest living entrepreneur. As long as he's around, there'll be ups and downs, but I think Tesla is going to be a dominant company. But when I have the experts on, and they've been wrong the last year, most of the last year, they're all like, I just don't get it. The math doesn't make sense. What I think they may be missing out, and you're probably going to disagree with me too, is understanding what Tesla and the dynamic of Elon Musk. It's not just a car company that's a part of it. They're a climate change company. They're a tech company. They're a big data company. They may completely dominate. Now, they said they were going to do this. It hasn't happened yet, but robo-taxis. They may be licensing out their software. So yeah, if you look at it traditionally, oh my God, it must be overpriced. Michael Burry is right, blah, blah, blah. Burry, I'm sorry. And he's great. I'd love to have him on, a great investor. But that might have been a short-term trade. So let's ask that same question for Netflix. Forget about the very short term. In the mid to longer term, do you recommend Tesla as one of those core holdings of 30 to 35 companies?
Well, I'll tell you where we are right now. So I think your assessment of Tesla is right. I've been one of those people who got Tesla. I think the biggest potential that's ahead of them is energy storage business.
Yes, I forgot to mention that.
I mean, you mentioned a lot of them. And the reason I say energy storage, right? So what are we saying, right? We used to have this, well, our present grid is these huge power plants that are concentrated, and then we ship the electricity on these transmission lines, right? Now we're talking about solar farms, solar panels over roofs, the wind. So it's all distributed energy. The problem is sun doesn't shine at night, right? Wind doesn't always blow, and so on. So we have to be able to store this energy in huge utility scale battery banks. And Tesla has not made big moves, but I think that's like $1 trillion plus business. Yeah. Okay, as big as the car business is, maybe even bigger. So if Tesla gets into that, and I think Musk has shown propensity to be successful, and they are successful, I think Tesla has a long ways to go from here. Okay. Now, having said that, it is not in our concentrated portfolio right now. Okay, because remember I talked about strategic and tactical, and that is more of a tactical decision. And in the interest of full disclosure, right around $900, we short sold Tesla. Okay, I'm really short selling sometimes, and it has been to 500 some range. Very profitable short-term trade, not long-term call, short-term trade. We've already booked profits on most of it. We have a tiny sliver left, which we're going to see somewhere here. We're going to book the remaining profits and be out. I would be looking at adding Tesla back to our that concentrated list of 33 stocks. I don't know what the timing is. Normally on that concentrated list, we don't trade in and out. But Tesla is so volatile that, you know, when it hit 900, and I thought it could go down to 500, which it did for our models, that's a pretty good return in a short time. So we wanted to play that game.
I'll change directions a little bit and get to some of the controversial stuff shortly, but are companies like Exxon and Chevron a buy now? Or, I mean, they're kind of trying to go green, or is their ESG push basically bullshit?
Well, no, their ESG push is not bullshit. It's decarbonization, I think, is real. I think there's a lot of opportunity in decarbonization. But these are big, they're like super tankers. To turn them around and make money with decarbonization is going to be very, very difficult. So I do not advocate them, Exxon and Chevron, as a part of the core portfolio. To me, right now, they're trading stocks. You get in and out of them. Now, those people who do want some old fossil energy exposure, for them, we have one stock in our portfolio because we have a lot of investors who want something energy, traditional energy. And that is Royal Dutch Shell. And let me explain why. Royal Dutch Shell made a shift a few years ago heavily into natural gas. Now, Angelo, you very wisely talked about the world outside the United States, right? So natural gas, doesn't mean a whole lot to us in the United States because, maybe our home is heated with natural gas. But, it's not a heavy use. But if you go back to developing countries like China and India, even Japan, natural gas is big in power generation, in cooking, in all kinds of things. I mean, it's huge, LNG. So that's a little different from oil for transportation. And I think that's where Royal Dutch Shell shines, in addition to its oil properties. So there's a little more hedge, little more potential there. So people who would want traditional energy exposure in their long-term portfolio, that's the only stock we have right now. I would not put Exxon or Chevron in the long-term concentrated portfolio. I'll just use them as trading stocks.
And how do you feel about SPACs? And do you agree with Jeremy Grantham, the well-known investor, that they should not be illegal?
Well, I tell you, I think I'm a little bit too late. I think I should have jumped at making my own SPAC. I think
that's a great way to be a billionaire, perhaps.
Right. I think SPACs are great if you are one of the promoters. Beyond that, I have serious doubts. Now, over the last year, we have made a lot of money on SPACs, not as investments, just as trades. Okay. I mean, our returns on the SPAC portfolio, I think, is close to about 100%. And this is incredible, but only as trades. Most of those trades we held on for a month or 2 weeks. I would not put any of the present day SPACs in our long-term concentrated portfolio.
Explain your unique, you hinted at it earlier, the ZYX method. You have a unique background. You may want to give context to that. And then a little bit of a hook of the coming question to that. What is it telling you about the prediction, maybe more shorter term, of the price of oil? And we cannot have a discussion without asking about Bitcoin. So I'm throwing a lot at you there. Why don't I let you digest it and go for it?
Well, price of oil is, we're talking about $64, $65 WTI. Brent is a little bit higher.
Right.
Our call really is to use oil as a trading vehicle. Okay. For example, last week we took a short position in oil, right? Not many people do that. That goes against what everybody's saying. Maybe it'll go to 70. We think it may go to, and we're not trying to make ton of money. We have some leverage in that position, so leverage adds return. It's a very small position. Because we think this up move is totally overdone in oil, and we may get about 10% or so, add some leverage, you get 30%. But again, a small position, not a high conviction position. But again, long term is So we have two things going on in oil. One is we know that long term, the use of oil is going to go down. We know that. But in the medium term, I think all the hype about electric cars and renewable energy and all that is really not translating to real world, right? Because if you look at EV fleet out of the total fleet of cars, right? And then where else is oil going? Trucks, right? How many of them are going to be EV? Not many. Ships, planes, so oil usage is going to continue. So I think demand is not going to fall as fast as analysts are predicting, okay? But I think the sentiment against oil is going to be negative other than short-term trade. So for us, oil is again a trading vehicle right now. We're going to get in and out, just make those short-term trades. We're not going to take any long-term positions on oil at this time.
And how about Bitcoin? How do you feel?
Same. I know some people are true believers in Bitcoin. I'm not one of them because I tend to be very practical. I look at what returns we are generating. And in trying to do that, I don't want big drawdowns. I don't like drawdowns. I want high risk adjusted returns. And, I cannot really, in all honesty, predict that Bitcoin is going to be at $1,000 a coin 10 years from now. It might be. I don't know. Will it go down to $10,000, $15,000? It may. So I don't know that. But what I know is that I can trade in and out of it successfully and not have huge drawdowns. So again, this is in my bucket of something. When the signals are right, we'll have close stops, high risk reward ratios, and we'll trade. Okay. Other than that, we're not taking positions in Bitcoin.
And I'm going to press a little bit on Bitcoin.
Sure.
I mean, obviously, it's done incredible in the last couple of months. And many people are recommended. I don't know if I really get it, but it's doing so well. Let me put 1 to 3% of the portfolio. God forbid it goes to nothing. It's not good, but it's not going to crush me. And I actually think that's a pretty good philosophy relative to how it's doing. But I do think you should make your own decisions by doing some level of diligence and research. The Satoshi paper, why Cathie Wood, Tudor Jones, Druckenmiller, Mass Mutual, and other prominent investors are getting active. I think probably a minimum of 20, perhaps even 40 to 100 hours of research. Are you comfortable with the amount of diligence you've done on Bitcoin? And is there anything that could happen that would cause you to change your mind?
So, Angelo, I have probably over years, maybe over $1,000 on Bitcoin, okay? Just a research. And of course, some of my associates will spend a lot of time on it.
Okay, so you put a lot of time.
Lot of things we're able to put our arms around, have high conviction rates, figure out how to do it. Bitcoin, we have not been able to make a conviction as to where it's really going, okay? Now, 1 to 3%, that's a good strategy. But that's a good strategy compared to putting 15% or 20%, right? Or 10%.
Right. And I would say,
but the thing is, 1 to 3%, yeah. So, but there's so many things in the world we could do where we could say, I think this is an inferior way of thinking where we could say, well, we don't fully understand this. So we'll just go ahead and put 1 to 3%. I can think of a lot of things where we could put 1 to 3%, right? So I believe in having a conviction. And the biggest thing I see about Bitcoin, here's my issue. The narrative has changed. The last narrative was Bitcoin is going to be a currency. That I had 100% in my head, as close to 100% as you get in the Western world. That's not going to happen. Because the governments will never allow Bitcoin to be a dominant currency. That just will never happen. So I knew that. Okay, so good with that. At some point, we short sold Bitcoin when it was high and it was a good trade. The new narrative is it's a new asset class, right? And with what Fed is doing, what ECB is doing, what Bank of Japan is doing, inflation is going to heat up. So we better have something. We better have things, right? Tangible things. Well, equivalent tangible digital word is now Bitcoin. That narrative, there is some. So I agree with the part that what the central banks has done is going to come back and bite us someday. I also agree with the part we got to diversify and looking for areas where we can protect our wealth. I'm not sure if Bitcoin is one of those at this point. It might be, I don't know.
No, that's a fair assessment that even with the 1,000+ hours you put in, you're not necessarily negative, but you're not overly on board. You want to see how some of the data and the metrics play out and be more patient. And at least that's an honest perspective and opinion.
Right, that's the honest answer. We can't really figure it out. And that's why our present posture is we're going to trade in and out of it.
Okay.
So we'll still make some money on Bitcoin, but we don't have a long-term solid commitment.
And lately getting a tremendous amount of coverage and even more complex in many ways are NFTs, non-fungible tokens. Right. Why don't I start by asking the question that gets attention? Are NFTs a Ponzi scheme?
I don't know. I think NFTs have a merit to them. World is moving digital. So all aspects of the art world, let's talk about art for a second, right? That I'm interested in, on music world. All aspects, with the exception of the art itself, have becoming increasingly digital, right? Now we're talking about digital art, okay? I'm not sure if I want to take a painting from old master hanging in my living room and replace it with a TV screen of a digital art. I'm not there, but talking to my son, he thinks that'll be perfectly all right.
Exactly.
So I think there is a merit to it. And now we're coming up with a method of authentication, right? Let's talk about a painting, right? So if you're going to buy an old master painting, again, authentication is an issue, right? Depending on where you're buying, how you're buying. With a digital art, it's even a bigger issue. So I think NFTs have a merit. Unlike Bitcoin, I am on board with NFTs. But then the question is, as an investment, is there enough data to us to buy things and feel really good about it? I think if you're knowledgeable about certain aspects, just like any art, I think it's okay to put some money into it. But I would not say investors should venture out of their own area of expertise in art or the area of expertise of their advisors that they really, really trust. You see what I'm saying?
Absolutely. Warren Buffett says interest rates are to asset prices what gravity is to apples. When there are low interest rates, there is very low gravitational pull on the asset prices. What will happen to stocks, real estate, Bitcoin? If rates rise to 5 or 6% in the next decade, while at the same time the dollar falls. Yeah, that's a deep.
So Warren Buffett has a luxury. He's very rich. He's also now at an age where he's not trying to make a name for himself, but again, I don't know what his temperament is at this age. Most of us, I think, first of all, we're not as rich as Warren Buffett. Second is, we still, I think, are not at an age where he is. So we have to deal with things, I think, a little differently. For example, real estate. I think real estate selectively should be sold. These high prices we have today should be used as selling opportunities, reducing the exposure to real estate. That's my take these days. Precisely for the reason that Warren Buffett said, that what if interest rates go up to 4%, 5%, right? So let's go back to real estate. I know it's local and class A properties and profit properties. I know all those things. But the basic calculation, now here I do believe in ratios unlike stocks, right? Basic calculation is your cap rate, right? And your cap rate is going to change with interest rates, right? So if interest rates go up 4 or 5%, the cap rates that are there today, they're just not going to survive. And the prices are going to come down. And, you know, and I'm not talking about homes, I'm talking about commercial property.
I asked a little bit earlier about Tesla. I'll
Sure.
make the assumption you're familiar with Arcimoto or Tesla. Which
Yes.
one would you hold over the next 5 years and why?
If I had to pick one, I'll stay with Tesla, simply because there's more of a record and there's more of a diversification. And you know, I spent a lot of time with utilities in this country, electric utilities. You know, people who know me from a long time ago, once upon a time, you know, nuclear power was a big thing. Not anymore. About 60% of the nuclear plants in this country have my hands personally or my company's hands in starting them up. So I know a lot about power and utility. And I think the opportunity for storage of energy, storage of power is just so huge. Okay. And Tesla, I think, is sitting right there, very well positioned to capture it. Now, will they capture it? Will they succeed? Will they try? I don't know any of that. But I see that huge opportunity.
I agree. That's kind of why I asked it. And when I get to, and I know I led off earlier in the show with sharing some of the unique holdings in part of my portfolio. We're going to get to that shortly.
Sure.
Arcimoto and Tesla, but everyone knows Tesla, but Arcimoto, not everyone does. Hopefully I'm pronouncing it correctly, is one of them.
No, that's good. That's good. It's good to have unique holdings. Sometimes they work.
Yeah, and sometimes they go to nothing. But that's part of investing and why you should be careful.
That's right.
Manage your exposure.
That's right. And that's where, you know, comes into, you know, your risk control and portfolio construction and all those things that are so important.
I promise we'll get to that in a couple of minutes.
Okay.
Is GameStop, Koss and AMC a sign of irrational exuberance?
Yes, definitely. I mean, it's just, you know, again, I never let opportunities pass by. We have made a fair amount of money on AMC and GME, again, for very short-term trades. But would I hold them on as an investment? Absolutely not. I mean, you know, I mean, AMC, if you do it, again, forget the ratio, right? If you do something simple, look at their debt service levels, and let's assume that people go to movies as much as they used to before pandemic started, which is questionable proposition by itself. They're not going to be able to pay back their debt. So what happens?
Yeah, that could not be a pretty picture. Is CRISPR, the company, is CRISPR the next potential 100x, the same way that Tesla led the way in EV stocks years ago?
So I know Kathy Wood is very popular. She talks about genomic revolution. CRISPR is one of her top holdings. Interesting, there's a company in Nutella, symbol NTLA. And from the top of my head, I think, and I could be wrong on this, the exact number, but I think she's holding 20 or 30% of this company now, which is in the same business, gene editing. I tell you, I take my cues out of all the people on that side is from my daughter. She knows something. She went to Harvard Med School, got her doctorate under George Daly, who at one time was named under the 100 most influential people in the Time magazine a long time ago, was dean of Harvard Med School, went to MIT, built the first artificial gut using stem cells. So she knows this stuff. And she is always warning me of two things when looking at CRISPR as an investment. One is there are more and more companies getting into it, and there are more and more newer techniques that are being developed. That's one. The second is, our assessment is that there's a very good chance when it goes more on a scale, we're going to start seeing problems like tumors, like cancer. The jury is still out on all of that. So I would not be as bullish as Kathy Wood is on this. So our posture again on these is right now is more of a trading posture. We'll take on a position with the time horizon of 6 months, year, 3 months. But we are not investing in these for the 10-year horizon and not putting them in our concentrated core portfolio.
If you're familiar with eToro, is it overvalued at 10 billion?
Well, I tell you, I bought some SPAC with eToro today. And as a matter of fact, recommended it to our subscribers. And this is what I said. I said, look, remember, if you can do this, this is not an investment. This is a short-term trade. Okay. We don't know if it's going to work or not, but here's the thing. We're going to buy this thing around $12. Your stop is going to be $2 lower. But if it catches momentum, you could double, triple your money, right? With a risk-reward kind of ratio. There is another company, symbol is TIGR, which is like eToro, Robinhood of China, that your investors may want to take a look at. That I have not bought yet, but I think that may turn out to be a better bet than eToro.
Yeah, no, good points. Are psychedelic companies like Compass Pathways, MindMed, Cybin potential disruptors of traditional pharma?
Yes. And we have done a lot of work. I depend on my children. My son, who has a doctorate, is a scientist. He's big time into analyzing all those things. And of course, he's a great analyst. And his call is, yes, these are disruptors. We got a long list of things, both public and private investments that we are always looking at. The problem we are running into these psychedelic companies is, especially in the public arena, the valuations are just totally insane. You mentioned earlier about valuations. So when I'm looking at a valuation of, let's say, Tesla or Amazon, that's one thing, okay? But when I'm looking at a valuation of a psychedelic company that has no revenues, it's very hard to swallow the like you talk about Compass and so on, the valuations that are out there. So they're on our list. We want to buy them. We are looking more at private companies right now. Maybe we can get better valuation. Maybe we can't. So that's where we are. But I think they are potential disruptors, definitely.
And back a little bit to a commodity-centric question, are we entering into a new commodity super cycle where the price of oil this year could reach $100 a barrel, and could uranium be $100 a pound?
Okay, I'll tell you about uranium that I feel pretty good about. There's always a risk of, one thing I've learned in the investment world is that it's always humbling. Sometimes when you get too sure about something, you're wrong.
Yeah.
I don't know, Angelo, if that has ever happened to you or your family.
Like every day.
Watching. So, I told you, I grew up as a nuclear physicist and know something about uranium. As I said earlier, over 60% of the nuclear plants in this country have my hand in starting them up. And based on that, I think this whole uranium thing is a total BS, total pump. And let me explain why. First of all the uranium deals that I've been familiar with are bought on long-term contracts. 20-year contracts, 30-year, 40-year contracts. And those contracts for existing power plants are, for the most part, are already in place. Okay. Now, some power plants are getting life extension, so then they need an extension of a contract. So uranium is not like a copper where there's a spot market. Yes, there is a spot market and they quote the prices, but that's meaningless because nobody's buying and selling at those prices in any volume. Okay. So the long-term contracts are already in place. There are not many new long-term contracts being negotiated right now. We're not building a lot of new plants. So, and the other use is, of course, in weapons. You know, we're not accumulating massive new nuclear warheads anywhere in the world. So the demand is really not there than it was before. So let's talk about one of the, you know, I'm not talking about smaller companies, but CCJ, right? Chemical, Canada, one of the bigger producers, more stable, sizable company in uranium world. You know, stock moves up quite a bit with all this thing about uranium, this and that, and MarketWatch has gone up. Are their earnings going to go up? I don't think so. You know, and when I talk about earnings, and there were some special charges and so on and that thing. But if you took that out and took the core earnings, I think their core earnings are going to stay the same over the next 5 years. So I don't buy into the uranium thing at all. Now, your question about commodity super cycle, you know, I call the last commodity super cycle the beginning, the end, rode it on the long side, rode it on the short side, on the end. Honestly, I cannot tell if this thing about commodity super cycle now is, again, just a short-term fad or is it real? And the reason I say that is this. Last one was pretty clear, commodity super cycle, right? So for example, China was extremely poor, right? If you look up their GDP chart over the last 30, 40 years, where they were. So they're building all these houses, these buildings, right? They're putting copper pipes, right? India is doing the same thing. They're putting copper pipes. So you know copper demand is going through the roof. Okay. Whereas in the United States, we're building houses, but we're not building at the same level, right? For copper demand and so on. If you look at the housing market in China, yes, there's still a lot of people, a lot of houses to be built, but the scale of what they have to build now is not going to be anything like the last time. India, the scale they're going to build now is nothing like last time. And the same thing if you start looking at other emerging markets in Asia or Latin America. But now we got Africa, right? But Africa, they don't have any money to buy copper anyways. So I'm not sure what happened. Now, there will be some demand. For example, EVs are going to use more copper, right? Electric conductor is copper. And so on. So, but I don't know if we're really running into a commodity super cycle or it's just like a mini boom. I know conventional wisdom is we're entering a commodity super cycle. I don't know. I'm playing it as though it's a mini boom. We've taken positions in commodities, but you know, shorter horizon, not 10-year horizon at this point.
What is your highest conviction pick over the next decade, and what would cause you to change your mind?
Interesting question. You know, people used to ask me that question. I always had the answers. Right now, I don't even have an answer. I do not have a high conviction pick over the next 10 years. I don't even have a high conviction pick over that.
What would be a couple of companies that may be of consideration?
Sure. So when I look at high conviction picks right now, okay, a company like Dexcom comes to my mind. But I wouldn't buy it right here. it's not in our portfolio. The reason, so Dexcom has a glucose sensor, right, for people who have diabetes. So basically, right now, people who have diabetes, they have to poke their finger every morning, right?
Yes.
This thing, you install it once, it gives you a reading all the time. So if you look at what has happened over diabetes, it's not slowing down. People are getting richer, they're eating bad, there's more diabetes. So that's an area that's going to grow, right? There's tandem diabetics, there's a very small cap firm, symbol is SCNS. So that's an arena where I think I have a pretty high conviction. Now, I have a high conviction about the business and the total dollars that are going to be spent. I don't have a high conviction about one company that this company is really going to end up dominating. You see what I'm saying?
Yes.
So what has happened? Actually, what has happened is over the last year or so, my conviction about companies over the next 5-10 years has gone down. Okay, and the reason is, go back to your earlier stuff, is the valuation. So let's remember, let's go back a long time ago. Let's talk about two companies that every investor knows, Walmart and Microsoft, right? Walmart was great, stock was great. And then Walmart grew like weed all over the country. Stock was stalled for a very, very, very long time, right? Same thing happened with Microsoft, right? After the antitrust thing got stalled. Great company.
Mm-hmm.
So, and that's, earlier I said, when we're talking about valuations don't help you to make money, but they help you control risk and what's in your portfolio. When I look at the valuations of everything I look at, the question I always have to ask is, if this company triples, quadruples over next 10 years, and let's say the interest rates go to 4, 5, 6, 7%, will that stock be higher 10 years from today, from now? I don't know the answer to that. It might be lower.
And everyone, I am not being rude to our guest, I promise, but I did mention I would open up my Robinhood, which is what I just did here on my phone.
Okay.
It's like a side account for me that I take more aggressive bets in general. And I wanted to share among the 20 or 22, maybe we don't have time to do all of them. Maybe I'll pick 2 or 3. And some of them are very small. So if you simply, I don't have any research or thought on it, that's fine.
Sure.
I'll move to the next one. What I might do is I may do a full program dedicated to this and get professional feedback. But for now, I'll just pick a couple. Let's see. I do have Spectrum Pharmaceuticals. Are you familiar with them? SPPI.
Yeah, that's on our list. And right now we have a kind of hold on that.
Oh.
Okay, so I really can't tell you buy or much. It's on our list that we watch. It's on a smaller list that we watch, but we're not there to say buy or hold. What's the next one?
SBRCY, Siberia Bank.
Don't know that. Is that a Russian bank or is that a?
Yes. You're going to laugh at the next one. I'm just going sequentially.
No. I want to comment on your Siberia bank.
Okay, go for it.
So we have gotten in and out of Russian companies for a long time, and they're always intriguing because typically from a valuation perspective, they're very, very cheap.
Yes.
And so, no, I have not looked at Siberia Bank, but there's another Russian bank that we looked at a few months back and really loved it, but really never took on a position for the obvious reasons. Now, if you're interested in Russia, now these are not cheap companies. There are 2 of them, Yandex, which is their search engine, symbol YNDX. And they have e-commerce companies, the recent IPO, Ozon, OZON, not valuation stories, but worth looking at. And also, earlier we talked about ETF for international market. For Russia, our really mainstay has been ETF RSX. And it really moves with oil prices, with obvious reasons. So, again, this is trading. So we have taken position in RSX quite often, again, with a 6-month, a year horizon, in and out kind of thing. But I suspect the Siberia bank that you have, it's probably trading at a P of 2 or 3 or 4 or something like that.
Yeah. From that perspective, although I knocked that a little bit earlier, for sure it was attractive. I'm chuckling at the next one because I think we already got your opinion about it. But URNM, North Shore Global Uranium Mining.
Yeah, I would sell it. I would short sell it.
Oh, okay. Well, thanks for the advice. Are you familiar with LUKOY, Luke Oil?
Yes. I think Lukoil has some merit to it, simply because it is inexpensive. To talk about Exxon and Chevron, I think there's some merit to Lukoil compared to those stocks, simply because the valuation difference is so great. And if oil does go to 100, I think Lukoil will work. On the downside, I think the downside is somewhat limited compared to potential reward. So yeah, if I had that, I would hold that. Maybe even consider buying it.
We did mention one before, that was the Arcimoto. I find them to be intriguing, so we don't need to necessarily visit that again. Another one is a big company. I'm intrigued by what they're doing in real estate, but I think it's not without risk. That would be BAM, Brookfield Asset Management.
Yes. That is on our radar. We look at it again and again. The issue is, we have a macro view, right? We always start with a macro view. And our macro view, against, is kind of anti-real estate right now.
I could tell from what you said earlier. And maybe the last one, Plug Power.
So Plug Power is in our portfolio. So the way we do that in individual stocks is we have a concentrated portfolio of about 30 plus stocks that we try not to trade in and out of, and hold on, hopefully for a horizon of like 10 years. Although, as I said earlier, my conviction in almost all of them has been going lower and lower this year, simply because the valuations are so high. So we'll see. But then what we do is we take the core portfolio and then we surround that with another group of stocks, okay? Some longer term, and the difference is we're more open to selling them, or the quantities are smaller, position sizes are smaller, and then some are just trading positions. So we have a Plug position still. We kind of took it on more as a trading position. We bought it around 4, and in my infinite wisdom, around 7 or 8, we said, well, doubled our money in a few days, we're done, get out. Bought it again, I think around 10, and then rode it all the way to 65. So around 65, we sold most of our position, but we have a small position still left that we're still holding. Now, Plug has potential to become a very large company.
Right.
Okay. So, and that's why, when our subscribers write and they say, Nigam, you did great getting us in at 10. You did great getting us out of most of it at 65. Why didn't you get us out of all of it? Because look at where it is now, right? Well, to 30, right? Since then. And my answer is, I go back to the same thing, that you have to look at a time frame. So always started out as a trading position, but it has become obvious that this company has started becoming a very large company. So at this point, I'm not comfortable to put it in our core 30 positions or have a very large position size in it. But I think it makes sense to have a small position relative to your portfolio in this company. And that small position, kind of treat it as a core position, not trade in and out of it, I'll just hold on. And then we use a concept of what we call the trade around position, which some of you people might be familiar with. So for example, let's say we have a Plug position, I don't know, I pick a fictitious unit of 100, right? We're Plug position core we're handling. And we want it to be small. So compared to 100, our position in Apple may be 20,000 or something like that. And then around that 100, we may take a trade around position of 1,000, 2,000, 3,000, even 20,000, depending on what it is, for a very shorter time frame that will get in and out. So that's kind of our plan with Plug. We've got a small core position that we intend to hold for a while, maybe a long time. We may add to it as more data comes available. And Plug is a kind of position that has the potential to kind of get transferred into that 430 plus stock someday. It certainly has those characteristics.
Well, I'm glad I ended on a good one.
Okay, you had a good one there.
I will do a little bit of a read for everyone. First of all, those were simply tiny account that I have in Robinhood. They're meant to generally be very aggressive positions. They may absolutely go to nothing. Most of them probably won't do specifically good, but I'm hoping some of them take off. I would almost call it play money, if that's the right word. And I will remind people that because we're recording this, I don't know when you're going to hear it, a day later, a month later, a year later, or 10 years later. Things change incredibly rapidly in today's world. This is simply from me and my guest, our opinion. It's meant to be engaging. You may have a very different opinion and you may be right. And also it's meant to be somewhat educational from our perspective and entertaining. You need to do your own diligence. When you make investments, what could happen? You could lose all your money. You need to be familiar with your risk tolerance, your time horizon, your diversity, your immediate liquidity needs, and simply what makes you sleep comfortable at night. So these are all things that you'll have to make your own decision on. This is simply for engaging, entertaining, somewhat educational, but based on opinion from our perspective. So I hope you enjoy it from that side. But again, incredibly, for the 10th time, do your own diligence.
Angelo, let me say something here. I want to second everything Angelo said, applies to everything I said here. But also for compliance reason, I do want to clearly state that everything I've stated here is not meant to be a buy or sell recommendation for anyone. I could be totally wrong. Just use anything I've said for information purposes to start your research, that's fine. But don't buy or sell something because Negum said so. Please don't do that. It's not meant that way at all.
Exactly. And Negum, for those that would like to learn more about the Arora report, maybe follow you on Twitter, subscribe to your services, how could they do that?
Well, you can follow me at Twitter at the Arora Report. That's THEARORA Report, REPORT. Remember, in my name, there's no U, ARORA. Or you can go to the Arora Report, THEARORA Report.com. and subscribe from there.
Great.
And just for 1 second, Angelo, we do have a very large subscriber base all across the globe. About 35–40% of our subscribers are professional money managers, investment advisors, stockbrokers. Remaining 60% are mostly wealthy individuals.
Excellent. No, I'm a big fan. I love what you do. And again, everyone, that's the Arora, spelled ARORA, the Arora Report. Highly recommend it. Certainly follow Negum on Twitter, which I do, and hopefully subscribe to his services and get value from it. Everyone, I'm Angelo Robles. I'm the host of the Angelo Robles podcast and the founder and CEO at Family Office Association. Go to our website. There's plenty of information to learn more, possibly about membership. It's simply as familyofficeassociation.com. Follow us on social media. I'm pretty active on LinkedIn, Instagram, and Twitter. New to Clubhouse, but haven't done anything yet, but I'm on it. The one I'm really most active on lately and looking to really build up is my YouTube platform, and same name as my Twitter. We're simply Family Office, so it's easy to find me. Go check it out, go and subscribe. On that note, again, Negum, it's been tremendous having you on. Thank you for giving me the critique of part of my portfolio. I look forward to talking to you a little later in the year. Thank you.
Thank you, Angelo. Thank you for having me.
Pleasure.